Hi, I'm Todd Rosenbluth, head of ETF and mutual fund research at CFRA and a contributor to wealthmanagement.com. I'm joined today for this fast chat with David Dali, head of portfolio strategy at Matthews Asia. David, thanks for joining me.
Happy to be here, Todd.
Well, great to have you here. So, we're going to be talking about emerging markets. How have emerging markets evolved in the last few decades?
Well, really, much has changed since the heyday of emerging markets investing back in the early 2000s. In fact, from 2003 to 2007, the BRIC economies, referring to Brazil, Russia, India, and China, led one of the strongest rallies on record. Cyclical export-oriented businesses thrived, commodity and resource companies jumped, and the prospects of a consumer-led boom led by China took hold of markets. Now, although half of that BRIC acronym, Brazil and Russia, have disappointed in terms of growth over the last decade, EM can still provide important cyclical value-oriented exposure, which can be additive during times of post-recovery. Now, we've witnessed some of that benefit in the last 18 months from the market lows in March 2020. Now, what has changed is the influence of Asia within EM benchmarks. Asia now represents over 75% of the MSCI EM benchmark, which means to succeed in emerging markets, you really do have to get the Asia part right. And within Asia, China's become the epicenter of growth and influence, followed by South Korea, Taiwan, and India.
So, you talked about the evolution, but emerging markets have underperformed the developed markets, US markets in particular, in the past decade. Do you think investors should look at emerging markets differently in their portfolio given the higher volatility?
Well, yes. I mean, certainly in my mind, EM should certainly play a role, in my opinion, in people's portfolios. I mean, first, you are correct. EMs have certainly underperformed during the last decade. But remember, and you might be shocked by this, the prior decade was almost the mirror opposite, where EM dramatically outperformed the S&P. Now, several factors have contributed to EM's underperformance in the past 10 years. One prominent reason, frankly, is the incredible performance of US stocks. Now, we can all debate, whether US stocks will continue to deliver. Bottom line is that it's my opinion that emerging market underperformance is turning more favorable for a couple of reasons. I mean, first, the headwinds to US corporate earnings could come under pressure, with higher corporate tax rates and the tapering of US liquidity. But secondly, if you believe that we've entered a period of economic growth with slightly higher inflation, well, you've just described what we've experienced 7 times in the last 30 years. And during those previous periods, EM and Asia equities top asset class performers, higher than the S&P, higher than EFA. Now, why does EM perform typically well in post-recession? Cyclical recoveries typically come with synchronized global growth, higher commodities, higher interest rates, higher earnings, and a marginally weaker dollar, which all favor emerging markets and risk assets broadly. So, we believe that this post-recession scenario should play out much the same as previous.
So let's just talk about some of what's happening recently in emerging markets, in China in particular. The recent regulatory changes that China has implemented has created a bit of a risk in the marketplace. China plays about a 30 to 40% weighting within MSCI emerging markets and some other common benchmarks. How do you think investors can overcome those risks?
Well, there's certainly no doubt that being underweight China today is extremely popular. About 70% of our recent customer inquiry is all about China. But let's first put into perspective what a typical investor's allocation to China looks like. If an investor has about 30% of their equity money outside the United States, and 2/3 of that is typically in EFA or developed market-like holdings, that leaves about 1/3 in EM, which typically means they have about 4% of their allocation to China. So to answer your question, in terms of asset allocation, I'm not concerned with China's large weight in the EM index. What I would be concerned about is how you get exposure to China outside of a global EM investment. I mean, unfortunately, as of today, China's ETFs that are available to investors have some really serious shortcomings, and they're blind to the regulatory risks you just mentioned. So I strongly favor an all-share approach to China. In other words, as an investor, you shouldn't have to choose between China ADRs in the US, Hong Kong listed shares, or locally listed A shares. investors. Investors are much better off, in my opinion, to find an active all shares manager that can allocate amongst the various jurisdictions with an eye on corporate governance, avoiding those regulatory headwinds you just referred to.
That makes sense. So if somebody wanted to build a portfolio using emerging markets, how do you think it should fit into the global diversified portfolio? Do you have a percentage in mind or a range that investors should have?
It's a great question. And listen, I'm a US investor. I make US dollars. The majority of my personal investments are in the US, and I have a home country bias. And when I speak to clients, similarly, they have 20, maybe 30% of their public equities outside the US, with the majority of holdings, as I mentioned, in EFA, with a small sliver in emerging markets. And it usually equates to 5 to 10% of their equity holdings in EM. Now, that all seems fine. I like having 20 to 30% outside the US, but I believe the international allocation should be flipped. I believe the average investor has far too much allocated to EFA and developed Europe. Now, why is that? I believe that we should all recognize the rapid evolution of what I would call a second sphere of influence in global investing. The first sphere of influence is the US and probably will always be the US. The second sphere has historically been Europe via our allocations to EFA. Now, I would argue that the drivers of international returns are moving east, and they're moving east very quickly. The second sphere of influence is now Asia, specifically Asian emerging markets. Now, it's not only because of the massive size of these economies or the growth of their capital markets or the fact that I work for an Asian focused money manager. What I believe is that Asian companies have more attractive fundamental metrics in aggregate. I mean, historical 3-year EPS growth has been higher in Asia than Europe. Historical 3-year sales growth has been higher. Forecasted EPS growth is higher in Asia. Or return on equity is higher, and valuations in Asia today are lower than EFA. So bottom line, to answer your question, how much should you have in EM? I believe your international allocation should be 1/3 developed Europe and 2/3 Asia and emerging markets. Now, how you slice up your Asian and emerging markets depends on your current holdings and risk tolerance.
So let me hand you my analytical hat and ask you to look into your crystal ball about emerging markets. What might we be talking about if we're here 5 years from now or 10 years from now? What's in the future for emerging markets?
Well, first, I would say that 1 year from now, we will not be talking about Chinese regulation. I believe that the severity and cadence of the damaging Chinese regulatory headlines has peaked. Now, going forward, I believe that company fundamentals will outweigh macro-related headwinds in China. Now, overall, I believe that EM is compelling over the short term, and that's because of its exposure to the cyclical recovery. Now, of course, in my mind, the easy money's been made, but we do expect earnings to stabilize at a very attractive 10 to 15% growth rate into next year. So it all looks fairly promising short term, especially in China. Now, I believe the next 5 to 10 years looks fairly compelling as well. First, why is that? Well, first, I would say governance, transparency, the recognition of shareholder rights is really improving. A larger share of profits is going into shareholder pockets. Secondly, EM companies are profitable, and it's not just in times of cyclical recovery. EM companies, especially those in North Asia, Korea, Taiwan, China, and non-Asian countries like Brazil, can be very profitable, rivaling those profits in developed markets. So in the next 5 to 10 years, I believe the best investable theme within emerging markets, at least in my opinion, is to invest in companies and sectors connected to innovation, especially those in China and North Asia. Now, I have to admit, innovation sounds like a bit of a cliche or passing fad, but in reality, innovative sectors like IT, healthcare, communication services, consumer discretionary have been the best performing and largest contributors to Asian emerging market returns over the long term. In fact, the returns of these innovative sectors have almost doubled benchmark returns over the long term. So to conclude, as allocators, we always need to ask ourselves, will this investable trend continue? Well, we think it will. In fact, we think that the innovation theme in Asia is just beginning. We equate Asia's stage of innovation today to what the US was like in the 1970s to 1990s. Imagine if you could have purchased US innovation in companies like Microsoft and Genentech and Apple back in the 1990s. We believe that Asia's current stage of development the buying power, consumer preferences point to a very similar path of innovation. Therefore, we believe that finding an active manager focused on EM and Asian innovation should be at the core of every emerging market allocation today.
It makes a lot of sense, David. Thanks a lot for joining me. David Dali of Matthews Asia. Appreciate it. Everybody should just tune in and go visit Matthews Asia website to learn more information. Have a great day.